If you have most of your retirement savings in a 401k or an IRA, you could be in for a big tax bill in retirement. Today we'll cover why your tax bill could be higher in retirement. We'll show you a Roth conversion case study and show you how one couple saves almost $400,000 on their tax bill. Plus, we'll talk about the benefits of lowering your tax bill to you and your heirs. Welcome to Retiring Today. I'm Molly Nelson here with Clint Huntrods and Lauren Merkel. They're both certified financial fiduciaries. Clint has a PhD and Lauren is a certified financial planner. We're talking about taxes in retirement because taxes are different when you retire, Lauren. It's not the same as the working years.
It's not the same, and that doesn't necessarily have to be a bad thing. In fact, if you incorporate an effective tax plan prior to going into retirement, your tax bill in retirement can be truly affected way differently than in the working years. If you want to decrease your tax bill in the working years, you are very limited to a few different strategies. I mean, you could contribute on a pre-tax nature to a 401k plan if you have that available to you, or maybe to a tax-deductible IRA if you qualify for that kind of contribution, or maybe some charitable contributions you can use to deduct your taxable income. But you're pretty limited with the tools that you have. But in retirement, if you create that tax plan, now you have way more control opportunity over the retirement tax bill that you pay, which is how this couple that we're going to talk about in today's show saved about $400,000 off of their retirement tax bill.
And that's impressive. Most people are saying, I want to do just that. But before we can get to that case study, I think we need to set up why taxes are different in retirement. Clinton, a lot of it has to do with the fact that the money that you saved for retirement and in different investments are taxed differently when you start spending them.
Yeah, we think about the pre-tax balance that you have saved. You're deferring taxes until retirement. So assets that are in your 401k, if you've got pre-tax IRA, when you take those distributions out, those will be taxed at earned income brackets, similar to your working years and your paycheck.
Okay, so IRAs, 401ks, 403bs, pensions, generally taxed at your regular income. Social Security, though, Lauren, that one has a totally different formula.
Yeah, this is a surprise for a lot of people because some people think Social Security isn't taxed because, in fact, it wasn't taxed while you're working. But for a lot of people, most people in retirement, it is taxed. But we call Social Security tax favored because unlike the IRAs, the employer plans, it's not. There's a pension, there's a formula called provisional income that is a formula that takes your taxable income, half of your Social Security income, adds that together, and then that number will determine is your Social Security taxed, is part of it taxed, but at a maximum, 85% of your Social Security income could be subject to tax at your ordinary income bracket. So it's better in a sense that it's not 100% of the income that you take away from IRAs and 401k plans. At a max, it could be up to 85%.
And basically, I'm going to say it in real broad terms, it kind of depends on the other money that you make, how much you pay on your Social Security. That's what that provisional income is, right?
Yeah, the other taxable money that you make does go into that provisional income. So you add up all the taxable income, take half of your Social Security income, that equates to your provisional income, and then you apply that to the income brackets associated with that provisional income for Social Security alone to determine somewhere between 0 up to 85% of that Social Security income could be taxable.
Okay, we're talking about formulas. There's even a different formula for how the IRS taxes what the sale of stocks, bonds, and mutual funds.
Yeah, if we think about dollars that are being held in a taxable account, often referred to non-qualified or brokerage, those are dollars that as you realize gains or sell a position, you'll be taxed at capital gains rates. If you've held it for less than a year, that'll be short-term capital gains, which will be taxed at earned income rates. The goal is that often you can hold that for more of a longer-term approach, more than a year, and then that will be taxed at a preferred rate of long-term capital gains.
Okay, I think that does a good job of setting up how each investment could be taxed a little bit differently. But what people really want to know is higher taxes in retirement.
We're missing one.
Oh,
we're missing the most exciting one.
Oh, go, yeah.
What is it? The Roth IRA.
Oh,
These are dollars that as you have those dollars put in, whether it's the Roth 401k or you're directly contributing to a Roth IRA, or you've converted dollars in, those are dollars that grow tax-free, and in retirement you can take them out without a tax bill. That's our favorite one. Those are tax-free dollars.
Tax-free money is the best kind of money.
That is the best kind of money, and that sets up the other kind of money, which is the money that hasn't been taxed yet. Well, guess what? When you go to retire, you're going to have to pay taxes on that money. And that kind of sets up the problem or the concern sometimes of pre-retirees when they get into retirement. They've got all this money in that traditional 401k. They've saved, they've done the hard work, but then it comes time to retire. And I've heard you say it can be kind of a ticking tax time bomb.
It can be, and it's a big surprise because at your required minimum distribution age, which now for most people is age 73, so what that means is all that money underneath the pre-tax IRA or 401k plan at your required minimum distribution age, let's say it's 73 for you, you are mandated to take a distribution from that balance, and then that distribution is taxable at your ordinary income. So we have to kind of fight this mantra that you have heard probably for the last 10 years at least, is that wait until you retire to do any kind of tax planning, because in retirement, your taxes will be lower. But for many people in retirement, that's not necessarily the case, especially when we project out long term over the course of a 20 to 25 year retirement. The first couple of years in retirement, your taxes might go down, but because of the RMD, this tax ticking time bomb that you referred to, it could force you into the same tax bracket as what you were when you're working, or for some good savers, for some people, it could actually increase your tax bracket for the rest of your retirement. And that's what we have to get control over in the tax plan.
And Lauren, I like that you mentioned you want to do this early. You want to have that more comprehensive plan sooner that incorporates proactive tax planning strategies. We sometimes will see families we're getting to know for the first time. They've maybe worked with an investment advisor who hasn't helped them from a tax planning perspective. And then we start to uncover what it is. They start to realize, oh, I have a very short window of time to make changes. So the sooner that you can start to think more long-term about that, don't wait until you're 69, 70 years old and it's just a few years away. That limits the opportunities that you might have. Let's start to think of this, maybe even during your working years, there could be opportunities.
Yeah, and for most people, it's not too late. Oftentimes we hear this sentiment that, oh, I'm a year away from retiring, or I've already retired, so it's too late to incorporate any kind of effective tax planning. And that's not true, because for a lot of people, that first calendar year that you have been retired, that first full calendar year, can be the optimal time to incorporate some of these tax planning strategies to really put yourself in a better position for the rest of your retirement. So if you're listening out there and you're thinking, I'm already retired, it's too late, I can't do any of this stuff you're talking about, that may not be true for most people. You still have time on your side that you can implement some of these strategies to really improve your retirement tax bill.
So whether you're retired or maybe you're 57 and going, my RMDs aren't till I'm 73, I don't need to start thinking about them now. Here, I think possibly what we're about to show you could be a reason to care, because what happens is, what can happen if you don't do anything, you keep the money in the 401k or the IRA, the traditional IRA, is these RMD amounts will grow. So at first they might not hurt your tax picture as much, but Clint, as you look at the chart or the graph that's on the screen, that's not the RMD amount, that's the percentage that you would have to take. Explain what we're looking at there.
Yeah, so you're looking at that first year where required minimum distributions happen. They're forced to take 4% out each and every year, pay the tax bill on it. That's where the IRS is kind of saying, hey, you've deferred taxes long enough. It's time to start to take some of those distributions out and pay the tax bill. So it starts at 4%. But when you look at this chart, you can see that it continues to go over time. And sometimes families think, well, my assets might taper off over time, so that doesn't really matter. What if your assets hold true with
or even growth
over time?
Yeah.
Well, then now we're taking a larger amount out, up to 16% as we look way out at the end of this chart. And now if we think about our assets continuing to grow from where they've been, that can be an awful hefty tax bill that someone's going to be forced to take those dollars out and pay earned income on those dollars.
Yeah, so a quick example, let's say your prior year-end balance was $100,000, you take 4% out, that's $4,000, but the market did really well, you earned 10%, so now your account value the next year is even bigger, and the percentage you have to take out of that bigger account value is bigger, so the actual dollar amount you are forced to take out is bigger, which means your tax bill could be bigger as well.
Yeah, and I think there's a really good distinction there between you taking out and being forced to take it out. There's a formula, and that formula only grows the older you get. You're forced to take a little bit more out. That's why that percentage keeps going up and up and up, and that's why your tax bill can keep going up and up and up. So that's not what you want in retirement. So what can you do about it? Well, there is a strategy that you could use to lower your tax bill. We'll look at an in-depth case study next. Welcome back to Retiring Today. I'm Molly Nelson here with Clint Huntrods and Lauren Merkel. A lot of people have their retirement savings in a 401k or an IRA, and it can mean a big tax bill in retirement, but it doesn't necessarily have to be that way. We're going to learn about a couple right now who did some planning, took control, and saved a lot of money in taxes. Clint, tell us about our couple.
Yeah, as we walk through this case study, we've got a couple who lives in Iowa. They are 67 years old. Each of them has an IRA that is pre-tax of $500,000, and then they also have $100,000 of non-qualified assets that they have at the bank. So a total portfolio of $1.1 million. As we think through this case study, we have to use some rate of return. For this particular example, we're looking at a 7% rate of return over time with the way that they are invested and the time frame with which we're looking at.
And they're also going to have Social Security income. So they have their investments to derive income, but Social Security income, each one of them is going to have $2,500 a month coming from Social Security. We do assume a cost of living adjustment on that Social Security income. We're going to assume a conservative rate of 2%. And then as they conducted their lifestyle plan, they determined that they needed $90,000 of income for the first 10 years, those go-go years of their retirement. $90,000 after the go-go years, they don't need as much. They're going to drop that down to $75,000 of income, and we use an inflation adjustment assumption with this as well of 3% over the course of their retirement.
When we start to think about what their projected tax bill is, what we're just going to assume is they're going to live to age 95. During the course of their retirement, what do you think that their tax bill might be? We'll let you at home start to think, what could that be? We've saved $1.1 million. What do you think that their tax bill might be, Lauren and Molly?
My guess is it's going to be big.
My clue for you, viewer at home, is it's high. I've got it right here. You guys care if I take this?
Take it.
It's a big number. $1.1 million. Ironically, the same amount of money that they saved for retirement.
That's the tax bill.
The tax bill.
That's not the amount that they had saved for retirement. I mean, coincidentally it is, but that's the amount they actually paid in taxes over the course of their retirement. And that the majority of that is because they spent a good amount of years in retirement. That certainly helped increase that tax bill. But the big contributor to that is all of that money was saved underneath pre-tax accounts, never been taxed before. So when they took the income out outside of Social Security, it was all taxable. And that taxable nature of that money, that income, increased the taxes on their Social Security income. And then, of course, at their RMD age, they were mandated to take distributions. As we talked about before, that's taxable at ordinary income as well.
Yeah, and it's important to note that they didn't have a lot of other levers to pull in retirement to get different type of assets. We started the show and we talked about the different types of ways that retirement income can be taxed. They really had only one option, where they had to go to pay earned income on those dollars that they saved pre-tax. They didn't have a lot of choices. And that's something that we often see, is the families have saved in those pre-tax buckets, not necessarily realizing that that tax bill might be bigger than they think in retirement.
Yeah, because a lot of the talk going into retirement is, I need to save $1 million. I need to save $3 million, whatever that number is, without a lot of attention to where is that money saved? Where is the $1 million saved? Because just like with this couple, they had $1.1 million saved, but they didn't get to spend all of that 1.1 because they had this big retirement tax bill that they also had to pay as they go. So it's not just about how much money do you have saved, it's about where is that money saved? Have you created tax diversification within your overall plan? Because if you have, that is going to help mitigate the impact of the retirement tax bill and give you a lot more options as far as the money you can spend, increasing your spendable income, decreasing your tax bill.
And you might wonder, how can this be that they have that big of a tax bill? And what you see is on this chart that we pulled up on the screen, it is actually going to increase the tax brackets that they are in throughout retirement as their required minimum distribution goes up and up and up. And they find themselves actually into the 32% tax bracket in those later years in retirement with really not a lot of control at that point to really change much.
Okay, I'm here with the good news. I've got the good news. I get to deliver the good news. It doesn't necessarily have to be that way. There are some things that they could do or can do now, maybe at 57, 59, before retirement, To improve their situation, enter the Roth conversion.
Enter the Roth conversion. It's a part of one's overall tax plan, or it can be. So the first thing is make sure you create a tax plan. Everybody's tax plan can be different based on your circumstances, but a Roth conversion can be a really powerful strategy. Simply what that means is you take money from the pre-tax IRA or 401k plan that you never paid taxes on before. You convert that over to the Roth. Once it's in the Roth, it grows tax-free. You take the qualified distribution out later down the road. It comes to you tax-free. Now, the disadvantage is you do have to pay taxes on that money in the year you convert the money from the pre-tax to the Roth. So you want to be very careful with this strategy. And if you have $1 million in a pre-tax account like this couple, it doesn't mean you want to convert all of that $1 million in one particular year, or you want to convert all of the $1 million over the course of a 10-year time frame. Everybody's plan is different. You need to make sure you have that strategy laid out for you.
Yeah, let's go ahead and apply the Roth conversion to this couple. Is that where you're going?
Yeah,
Sorry,
absolutely.
Clint.
So let's just look at this chart. This shows this family paying a little bit more in tax earlier in retirement. But like you mentioned, Lauren, once they've paid the tax bill on those dollars that are in that Roth bucket, they're able to grow tax-free forever. And they are not going to be subject to forced distributions as those pre-tax balances will. So when they do that a little bit earlier in retirement, they are able to save $400,000 across their entire cumulative retirement tax bill. A huge impact of dollars that they can keep, spend, or pass on rather than send to the IRS.
Yeah, because what they did in this example is they took advantage of those early years in retirement where they were actually in the 12% federal tax bracket, right? They didn't have the high income from the earned wages like they did when they were working. They were taking Social Security income and distributions from their IRA, and then they filled up that 12% tax bracket with Roth conversion over a period of years, which really enabled them to save that big amount of money over the course of their retirement, because they had now this tax diversification where money was growing tax-free that didn't require distribution, and they could take out later down the road tax-free in combination with their Social Security income and their other pre-tax income from the IRA.
And the other thing to always keep in mind is this is showing both of them living for pretty long into their retirement. If one of them were to pass away sooner, now you're in single tax brackets, which are going to fill up even quicker, and that could actually lead to a higher retirement tax bill if one of them passes away sooner than living out into their 90s.
Our couple was able to avoid the 32% tax bracket. They were able to lower their tax bill from $1.1 million to $700,000 and save $400,000. Of course, this was a case study. This was one couple. We know that your retirement looks different. We've got an opportunity for you to talk directly with a retirement planner about what's on your mind. It's a Retire Ready call. You can schedule a Retire Ready call right now by going to retirereadycall.com. When you get there, you'll see a calendar. It's pretty simple. You choose a date, choose a time, then we'll reach back out to you so you can talk about what's on your mind and talk about your retirement. We'll continue talking about how to lower your tax bill in retirement, including the benefit not only to you, but your heirs, next. Welcome back to Retiring. Today I'm Molly Nelson here with Clint Hunt-Rodza and Lauren Merkel, and we're talking about your retirement savings. A lot of people have their money in a 401k and an IRA, and it can be a ticking tax bomb. We talked about that. But what about leaving that money to your children? Lauren, it could almost be like you're passing that ticking time bomb.
A lot like this.
To your kids and grandkids.
No, I don't want the tax ticking bomb.
I don't want
take
the
it.
There you go.
I want the money, but not the tax bill.
But that is literally what a lot of people are positioning their kids to receive. You have a tax ticking time bomb, but if you don't do something about it, when you pass away, you could be passing that on to your kids. If you pass away in your 70s and 80s, your kids are in their 50s, probably at their highest wage earning years, making a ton of money, and their income tax rate is already high. And then here comes your tax ticking time bomb in their laps. It could be devastating to the money that you've worked so hard and long to earn, just to pass that on to your kids who can pass it on to the IRS.
Yeah, you really need to diffuse that time bomb, and the Secure Act has really made it harder to do that. You think about somebody who inherits those dollars, they have a 10-year distribution window on pre-tax dollars where they have to have those dollars out and the tax bill paid within a 10-year time frame, stacking on, like you mentioned, whatever their household income already is.
Let's look at it in numbers. If you pass along a traditional IRA, we can show you kind of what this tax time bomb looks like.
Yeah, so if somebody's going to pass on $100,000, their kids are in the 24% tax bracket, they're not getting $100,000, they're going to get a net $76,000 that they're actually going to be able to utilize and be able to spend and maximize the things that they're looking to do. And so you can just see how much that tax will cut into an inheritance really quick.
Yeah, whereas if you would have done Roth conversions over the course of your retirement or incorporated an effective tax plan for you, when you pass that money on, maybe the kids pay 0% in tax on it. Maybe they pay a tax that's lower than what you than what they otherwise would have paid if you wouldn't have. And maybe, like going back to our couple, they were doing Roth conversions at the 12% rate. So you pay 12 on it and the kids pay nothing on it. All in all, you've worked really hard for this money. It's about how do you pay the least amount of money, including your legacy of passing that on to the kids over the course of your and your kids' retirement.
And what can be difficult, at least for me as I think about this, sometimes this is so long-term thinking. We've always thought about taxes as I earn this, I pay that, I go on to the next year. Do you find that when people are nearing retirement, though, Clint, when you sit down and you kind of spell this out again in numbers, you don't just say a tax bomb is coming and not explain it. You show them. Does it become a lot more real for people, and that long-term thinking is a lot easier to overcome?
Yeah, it's really a mindset shift. During your working years, you're going to file your taxes at the end of the year. Your CPA is going to try to lower your tax bill in that given year. With retirement planning, we want to think more long-term. And when we start to think more long-term, we start to bring in different graphs to help you see what is your projected cumulative tax bill, what brackets do you likely have throughout early years of retirement, how does that change when you get required minimum distributions that hit. Families then, they can see it for themselves, and that's where they really start to realize the importance and the value of having a proactive tax plan.
And I have to think, Lauren, for some people, this is the first time it's been laid out for them like that. They might be working with a financial advisor, but I bet they've been talking a lot about investing in earnings and returns and making more money each year. But when you lay out the tax bill like that, it's got to be eye-opening.
A large percentage of pre-retirees have never had a written, customized retirement plan because the conversation does tend to rely upon the investment type of conversation, even for those who have an advisor. But when we lay out that customized retirement plan for the very first time, their eyes really open up, and we do see a different shift in their mindset, but also their comfort level. Their comfort level with this thing called retirement that they've been looking forward to for so long. Now they can see a financial vision of how they're going to be able to accomplish what it is they're trying to accomplish in the most efficient way possible. And it's all based on your circumstances, your situation, and the income potential that you have based on the investments and resources that you have going into retirement. So it's very eye-opening, it's also very comforting, and it's very relaxing going into the retirement years.
I'm glad you brought up a comprehensive retirement plan, because check this out. It's a visual representation of just what you talked about. It's our Retire Secure roadmap, and taxes are on there, but lifestyle, income, investments, healthcare, legacy, it's all part of that plan. And it's all part of the conversations, Clint, that you're having with people every day during these Retire Ready calls. Everybody has different questions about different things, but a Retire Ready call is a really casual conversation about what's on people's minds.
Yeah, everybody's different. That's why it's so important to have a custom retirement plan for you. Because we talk about Roth conversions a lot and those types of strategies of getting away from those pre-tax balances over time where it makes sense, but your case might be different. Or maybe you've got a non-qualified account. You're thinking about highly appreciated company stock or something that you've invested in that's really grown. And so that might be what's on your mind. And that's where we can take it wherever it is that makes sense, whatever's top of mind for you, as we sit down and just kind of have a relaxed conversation, getting to know you a little bit more and seeing what kind of questions you have as you're thinking more about your retirement.
RetireReadyCall.com is where you can go right now to schedule a Retire Ready call today. Lauren, who should schedule a Retire Ready call?
If you're age 57 looking to retire and you have these types of topics on your mind, these types of questions, schedule the Retire Ready call. What I like most about it is it's very casual and it's custom to you, your concerns, your retirement. Sometimes people will be afraid of talking to an advisor for the first time because of the experiences they've had in the past with those conversations. It's not like that at all with us. There's never any pressure to do anything. We know we're not a good fit for everybody. We're not trying to work with everybody. What we are trying to do is produce enough information to help people on their way to having the retirement they want. And if it makes sense for us to work together, let's work together and we'll build your custom retirement plan. If it doesn't make sense, you will have more information that you can take to use to help you on your way to retirement. So it's no pressure, no risk. It's a good conversation to get people started to enjoying their retirement.
Yeah, best case scenario, maybe you walk away with a tip or a strategy that that you didn't have before the phone call. So that's retirereadycall.com. There's a calendar there. Choose a time and date that works for you. And then you've scheduled a Retire Ready call. This is Retiring Today, and we thank you for watching.
Thank you for watching. If you enjoyed this, click here for another video. Be sure to subscribe to get more engaging retirement planning content.